Good morning, everyone. You are watching a live market outlook for Tuesday, 10th of January 2012. Brief outlook on today's brief look on today's headlines. The euro remains steady, but faces pressure during this week. However, the wider picture of euro still remains quite bearish, but the recent recovery is still in play. The dollar is correcting lower. That pushed the commodities, especially crude oil and gold, higher in the near term, while Chinese yuan is also higher on the weaker dollar. The release from China of trade surplus of 16.5 billion shows the slowest growth in the past 2 years in December, according to the data released during the night. Euro risks fall to 120 on debt crisis in the short-term outlook. As I mentioned, the outlook for euro still remains quite weak, as there is still no signs of firmer steps from eurozone members in order to handle the crisis in a proper way. From the yesterday's news, actually, that shook the market is resignation of Swiss National Bank President Hildebrand, that was involved in the trading scandal, and he offered his immediate resignation. Now Swiss National Bank is looking for the interim solution to find the interim chief while the next president will be elected. United Emirates are delaying oil pipeline to bypass Hormuz as the growing tensions with the Iran and the US are threatening of closing the only way for the oil to come out of the Gulf. More to come. Actually, yesterday's release also of U.S. consumer credit shows that the indicator surged by most since 2001, which is very supportive and a good signal of further recovery of the U.S. economy. Also, the UK risks recession and lengthy stagnation, according to the latest analysis and data released. Now let's first take a look on the recent movements. Euro held steady overnight, currently is under pressure again, but held steady from in past 2 days recovery from yesterday's low at 126.65. As yesterday's positive data from Eurozone gave the additional boost to the single currency. Gold is ticking higher as weaker dollar on the short-term price action is currently pushing the yellow metal higher. However, the outlook for gold is still quite negative on the wider picture, as recent break below the previous low at 1532 posted fresh one at 1522, and the yellow metal is struggling to regain 1642 strong resistance. From US, back to this data of consumer credit released yesterday, showing that US consumer credit surged to 10% in November. That's its biggest jump in a decade, and a quite positive signal for the economy, as consumers tapped their credit cards and the government doled out more student loans. Outstanding release of consumer credit increased by 20.37 billion during the month. The Federal Reserve said yesterday, and this is the biggest gain since November 2001. And nearly the 3 times the median forecast for the indicator before it's released. The credit growth is positive sign for the recovery, and it signals increasing demand and willingness to spend, which shows that U.S. economy might be on the right track for further recovery. From China, just to have to take a brief look, as China's exports and imports grew at their slowest pace in more than 2 years in December, as foreign and domestic demand ebbed. The data showed on the release of the Chinese trade balance that showed the growth of 16.5 billion dollars compared to 14.5 billion October's release and 8.3 billion dollars forecast. Annual growth, export growth of 13.4% in December was in line with expectations, albeit the slowest since November 2011, except for a February distortion caused by Lunar New Year holidays. But it was a big downside surprise for import growth that caught investor attention, sinking to a 26-month low of just 11.8% year-on-year versus the 17% forecast by economists in the polls. From today's calendar, as mentioned, the China trade balance already released, and the building approvals from Australia already released, showing a growth of 8.4% compared to 6.6% forecast, and a negative release of the previous month at minus 10%. French industrial production already released, showing a growth of 1.1% compared to 0.1% forecast and the previous release. Still to come from Canada at 13:15 GMT, housing starts forecast for today is slightly better than the previous month release of 181,000. Today's consensus is 186,000. Economic optimism from US due at 1500 GMT. Also positive forecast at 45.3 compared to 42.8 the previous month release. At the same time, wholesale inventories monthly release from US expected to decrease to grow by 0.5% compared to previous month release at 1.6%. Speakers from FOMC due at 15:30 and 16:10. FOMC member Williams and FOMC member Pianalto are due to speak today. Now let's take a look on the markets and see the movements in the past 24 hours, starting with the euro. As we can see, the near-term price action shows the euro in the positive action from 126.65, yesterday's low, and fresh 16-month low, with the pair extending overnight gains through yesterday's high at 127.84, posting a fresh marginally higher high at 127.95. Corrective pullback. Now it's I would say not that corrective, as we lost the main near-term trendline support and the 20 days moving average, with threat now at 127.20, which is our main near-term support, loss of which would just signal lower top and fresh extension lower towards 126.65. Ability to hold above 127.20 would in a way keep the near-term structure still in positive tone. However, strong barriers come at initial barrier at 128.11, 128.20, which is the high of last Friday, and 38.2 Fibonacci retracement, with the more significant levels at around 128.60, 70. That marks 50% Fibonacci retracement, and the previous low, actually the low of 2011 at 128.72. That is expected to limit the upside, as strong selling pressure still remains, as the wider picture has shown on the daily outlook still firmly bearish, and the main target is at 120, below 126.65, will be at 126.00, which is Fibonacci 76.4 retracement of the broader uptrend from 118.75 low of 2010 to 149.38 high of 2011, and 125.86 is the low of 22nd of August 2008, and is the higher low of this ascent. So this is actually the focus now. Loss of these levels in the wider picture would signal possible extension down towards 123.22 that are previous lows, and a possible retest of the latest longer term cycle low at 118.75. Cable is also in the third consecutive day of recovery after hitting a low at 153.74 last Friday, just ahead of the recent range low floor at 153.60. It's better seen on the daily chart. As we can see, it's still moving within this range as long as 153.60 holds the downside. The pair extended gains to approach 155, a level which also marks 38.2% Fibonacci retracement of the latest down leg from 156.68 high of the 2012 down to 153.74. The hourly studies are still in a positive territory, but now started pointing lower as the latest pullback attempts through 20 days moving average, our initial dynamic support, currently at 154.55, with the higher low at 154.20 required to hold the downside in order to keep this near-term action higher still in play. On the upside, the next barrier comes at 155.10, which is the main short-term bear trend line from 156.68, and more significant level at 155.20 zone. That marks the last Friday's high and the 50% Fibonacci retracement of the entire leg lower. On the downside, loss of 154.20 would risk return down to 154 and possible retest of 153.74 and 153.60, and that would turn risk lower and look for a possible extension down towards supports at 153.26 and the key level at 152.71 low of 2011 posted on 6th of October 2011. Dollar yen also remains under pressure despite the dips being contained at 76.75 zone, just ahead of our key support at 76.50. This is the significant support zone, and while holding above here, there is still hope for a further extension higher. However, at this point, the latest strength of the dollar in past couple of hours is showing the attempt higher through 20 days moving average on the hourly chart for test of next levels at 76.90 and 77.00, 77.20. That is our key barrier. 77.20, 77.32 is the high of last Friday, and the daily 90 days moving average that is still that actually capped the upside attempts. So break above 77.20, 30 is required to keep the downside intact, and the 76.50, 60 support zone to keep intact for now, and for possible extension higher and retest of previous highs above 78 mark. On the downside, the loss of 76.75 to put immediate risk at 76.50, and possible extension lower towards 76.00 and pre-intervention lows at 75.56, a low of 31st of October, when the Bank of Japan last time intervened and pushed the pair higher. As we can see, the daily outlook remains still in the bearish territory and keeps the downside favored, with loss of our key short-term support at 76.56 required to resume losses and test previously mentioned levels 76.00 and 75.55. The dollar Swiss came under increased pressure yesterday after the fundamentals news from Swiss National Bank of resignation of its president, Hildebrand, that pushed the pair below the initial support at 95.00 and through the Fibonacci 38.2% also at this level, extending losses so far to 94.63, where the pair is attempting to base, as the wider picture remains still firmly bullish, with the daily 20 days moving average at 94 zone offering the key support. And while dips are holding above this level, the broader outlook will remain intact. However, on the upside, regain of on the hourly chart of minimum 95.30 is required to signal higher low at 94.63, the low of this morning, actually late hours of the Asian session, and to refocus levels on the upside with break above 95.93, yesterday's fresh high, to signal further extension of the broader uptrend. On the downside, loss of 94 zone, which also marks 61.8% Fibonacci retracement of the latest up leg from 93.03 to 95.93, would be risky in the short term, as it would signal a temporary top at 95.93 and allow further extension lower for possible test of 93, higher base at 93.03, the low posted of on 3rd of January. This is also the low of 2011. From commodities, brief look at gold. The hourly studies are still mixed, sort of positive tone exists. However, while 1642 previous high of 21st of November and 50% Fibonacci retracement of the latest down leg from 1763 down to 1522 remains intact, the pressure would be on the downside, with the further extension lower to possibly signal a double top at 1522 and at 1641 and 1631, with break below 1522 to confirm. On the near term, currently the gold is still ticking higher after a weaker dollar during the Asian session, with 1606 zone where the support was found, holding the downside for now. However, 20 days moving average at 1614 on the hourly chart is currently maintaining the latest gains, as the hourly MACD is attempting above the center line, keeping the scope for a further extension higher and test of our key near-term resistance at 1641 in play. On the downside, loss of 1600, 1590, which is our key support, would be risky for further extension lower and extension down towards 1561 and possible retest of 1522. The wider picture on gold remains still in the negative territory, as 200 days moving average at 1633 currently capping the upside action. The break here actually is required to improve the outlook. Studies are still negative, as the MACD is attempting higher, but still well below the center line, and the momentum also below its control level at 100, keeping the downside in focus, as the yellow metal is descending from its record high of 1920 posted on 6th of September 2011, and the recent fresh low posted at 1522 on 29th of December. Crude oil is again supported, as mounting tension with Iran is keeping the good support for energy prices. Near-term outlook bounce from 100 level, that is our key level at this point, and psychological support is currently lifting above 102 mark, looking for test of initial barrier at 102.77, high of 6th of January, ahead of a possible extension higher towards 103.72, the high of 5th of January, and this is the high of 2011. On the daily outlook, positive tone persists while holding above 199.18, which is 20 days moving average, as the crude oil broke above the main bear trend line from 114.80 record high posted in 1st of May last year, keeping the upside in focus. At this point, only loss of 98 level, I would say, would be bearish in the short term, as the 200 days moving average currently at 95.60 is still holding, but loss of the higher platform at 98.30 would be risky for the crude oil.